Look at a raw stock chart during a volatile session, and it feels like trying to read an untranslated foreign language. Red and green candles flash, prices spike, and the noise is overwhelming. We can translate that noise using an objective framework. This is the 30-second chart scan, a visual checklist designed to help you plan high-probability trades. Before we start the clock, you only need 3 things. Open your standard charting platform, pick a target asset, and make sure you understand the basic anatomy of a candlestick, specifically the open, high, low, and close. Relying on gut feelings when looking at raw data leads to heavy losses. To succeed, you have to replace emotional reactions with a strict visual checklist. Let's run through it. Step 1. Assess the big picture. We zoom out to identify the overarching market trend, moving upward, downward, or arranging flat. Then, we draw horizontal lines to map the battlegrounds, marking the lowest bounce points for support and the highest peaks for resistance. Here is a common trap. If you look at this section of our guide, it explicitly warns against forcing trades in a sideways market. If you draw your lines and see the prices just bouncing horizontally between them without a clear trend, stop the scan immediately. Abandon the trade setup. We draw these lines first because candlestick patterns are meaningless floating in the middle of nowhere. They only have predictive power when they occur right at these predefined boundaries. Step 2. Spot the pattern. Scanning near our boundaries, we watch for specific formations. At support, a bullish hammer's long lower wick shows buyers rejecting lower prices. At resistance, a bearish shooting star's long upper wick demonstrates sellers overpowering buyers at the ceiling. Sometimes you'll see a doji form at these levels. This specific shape indicates total indecision, a moment where neither the buyers nor the sellers are in control. The shape of the candle is not arbitrary. It represents the physical footprint of human psychology, showing you the literal minute-by-minute battle between buyers and sellers. Step 3 is confirming the signal. Finding a pattern isn't enough. We validate it using trading volume to measure institutional conviction. That brings us to our defensive rule. Never execute a trade based on a single candlestick pattern alone. To confirm the setup, wait for the subsequent candle to close in your predicted direction. A bullish hammer needs the next candle to close green. Trading without waiting for this confirmation is the most common reason amateur traders lose capital to false breakouts. These confirmation steps separate gambling on a gut feeling from executing a statistically proven setup. Step 4 is planning the trade. Before risking a single dollar, we mathematically define our entry, exit, and failure prices. Looking at this setup, we set a target for profit, plot our entry, and most importantly, place our stop loss. For a bullish setup, place the stop loss just below the bottom wick. For a bearish setup, put it just above the top wick. Here is the uncomfortable reality of trading. As this guide states clearly, absolutely no pattern works 100% of the time. That makes the stop loss a non-negotiable requirement. Risk management isn't a sign of weakness. It's the essential survival mechanism keeping you in the game long enough to become profitable. Our 30-second chart scan is complete. We've moved from a chaotic blank chart to a strictly defined emotionless trade setup ready for execution. This pro tip shifts your entire perspective. You are identifying a specific response for when the market hits your levels, rather than trying to guess where it might go next. Now it's your turn. Open your charting platform, select 3 random assets, and run this exact 30-second workflow using a simulated paper trading account. Repeating this process daily builds the discipline required to ignore market noise and act only on confirmed data. Every successful trade begins with a repeatable routine.